Hello everyone, my name is Anjani Kumar Khetan. I'm based out of Bangalore, and in this particular video, we will look at yet another interesting accounting topic, which is on how an issuer who has issued financial guarantee, how that entity or the person need to account for such issued financial guarantee. It's a tricky accounting issue, so we will deliberate on this. So in this video, we will see just the prelude of it, and we will continue our discussion as part of this particular topic in subsequent videos as well. So we will look at first what financial guarantee contract is as contemplated under Ind AS and IFRS literature. So what are they? So if you look at the literature, Appendix A to Ind AS 109, or for that matter, your IFRS 9, if you look at Appendix A, that defines financial guarantee contract in a very specific manner, and it says that a financial guarantee contract is a contract which requires the issuer of such financial guarantee to make specified payments for what? To reimburse the holder of the financial guarantee. Why? Because of the loss which that holder incurs because a specified debtor has failed to make payment when those payments were due in accordance with the terms of a debt instrument. You can see there are a lot of the content which is there in this particular definition. So let us bifurcate and try to get into the specifics of it. Let's say by way of a simple chart or a diagram, let us see what essentially a financial guarantee contract entails. So if you look at at the bottom, I've tried to kind of summarize it, what a typical financial guarantee contract will entail. So assume a scenario wherein, say this Mr. A. Mr. A has provided loan, let us say to this entity ABSPL. Okay, so loan has been provided by A to ABSPL. Now, Mr. A, this person purchases a financial guarantee, let's say from the bank, in this case, who is the guarantor. Okay, and for that, this person A makes a payment to the guarantor, which is by way of premium for getting the guarantee issued by this party in favor of Mr. A. Now, what this guarantee is going to serve? The guarantee basically will serve wherein the bank, the issuer of the guarantee, this entity will compensate Mr. A if this particular borrower who has taken the loan from Mr. A, if this entity were to default, and because of which Mr. A suffers financial losses, then B will compensate Mr. A for the losses which is sustained on account of the losses which are incurred or the default which has been done by the borrower ABSPL. Now, this generally, if you look at an issuer, will generally account for such a financial guarantee. That means this guy will generally account for such financial guarantee contracts in accordance with Financial Instruments Standard Ind AS 109 or IFRS 9. Now, maybe in a subsequent video, I will explain why we are saying generally, because technically speaking, these kind of a contracts subject to meeting certain conditions can also be classified as insurance contracts, which currently under Ind AS framework is accounted for under Ind AS 104 and which used to be earlier IFRS 4. Now, from a global perspective, IFRS 4 has been replaced by a new standard called IFRS 17. Okay, that is something which we will leave for a subsequent video. All I'm trying to say is that such kind of a financial guarantee contract generally will get accounted for under Financial Instrument Standard, which is in the Indian context Ind AS 109, or from an IFRS perspective, IFRS 9. So with this background, let's move further and see how these financial guarantee contracts are supposed to be accounted by the issuer In our case, the bank who has issued the financial guarantee contract in favor of Mr. A. Let's see how does it all work. So we are looking at accounting for issued financial guarantee contract. Accounting by whom? Accounting by this guarantor, the bank in our example. So what happens? The standard requires that on initial recognition and measurement, the guarantee should be, the issued guarantee by this guarantor should be recognized at the fair value of such guarantee. Now, this itself is a very intriguing question, how to determine the fair value. Okay, that again is a very, I would say, a kind of a topic which requires much more elaboration. We will pick it up perhaps in a subsequent video, but let's understand this, that the key requirement for accounting for such issued financial guarantee contracts is that on initial recognition, this issuer need to record such financial guarantee contract at its fair value. Now, as I said, what is the fair value? That itself is a very challenging kind of a discussion. But let us see what this says. In most circumstances, when you are looking at and dealing with financial guarantee contract, which is issued by a third party, which in this case happens to be the bank. Now, obviously, when bank is issuing guarantee to Mr. A in my example, then in that case, bank will ask Mr. A to pay some premium or compensation for that. So the guarantee premium which has been charged by the bank to Mr. A in most cases will serve as the fair value of such guarantee. So what the standard says that, let us say if 600 rupees has been charged, it can be 600 crores also. If 600 rupees, for example, has been charged by the guarantor for issuing the guarantee, then the fair value of the guarantee is likely to be 600. Assume that 600 is the fair value. The transaction is at arm's length with the third party, Mr. A. Therefore, the initial recording of the issued financial guarantee contract will be at 600 rupees. That's the sum and substance of this particular requirement. And therefore, how the entry would be recorded? The issuer, the bank in this case, would record the entry by way of cash of 600 rupees or whatever the unit of measurement is, cash 600 and credit the liability. Because by entering into this financial guarantee contract, there is a potential liability which the guarantor has, and therefore in the balance sheet, you will record, say for example, liabilities for from financial guarantee to the extent of 600 rupees. So with that said, now, so this is the initial recording of the financial guarantee. Now what happens? Let us assume that if the guarantee is issued to on behalf of a related party, or for example, let's say an holding company issues guarantee on behalf of the subsidiary company, it may be possible in those cases that the guarantor, the holding company in my example, if it is issuing guarantee on behalf of the subsidiary company, they may not charge anything to the subsidiary company, and therefore this piece would be missing, guarantee premium charge. That would not be available. So what happens if the financial guarantee is issued within the same group entities? Generally, they are issued without any fee or the charge. Now that creates much more complication in terms of, then in those cases, how do you determine the fair value of such guarantee issued by the holding company to subsidiary or vice versa? Okay, if it is possible, which is at what should be the fair value of that particular guarantee which have been issued by the holding company to subsidiary. That is something has to be determined in accordance with the fair value standard, which is Ind AS 113, or from an IFRS perspective, IFRS 13. And if that happens, that if there are nothing which has been charged, so what will happen? A holding company is not charging anything to subsidiary, zero. So therefore, continuing the same example, if the liability of 600 continues, the journal entry would be recorded as if 600 would be the credit, which is fine. But what about the debit? Debit corresponding to the fair value of the guarantee, which is 600, will be debited on the basis of what is the relationship between the two parties, the guarantor, and on whose behalf the guarantee has been given. So therefore, in this case, because there is a holding subsidiary relationship, the debit can potentially go to, let's say, investment in subsidiary. It will be deemed that to the extent of 600 rupees, the holding company has made investment in subsidiary. Of course, it is not the equity share capital is not being issued. It is like other equity which is invested in the in the subsidiary company. We will deal with it in greater details, perhaps when we have the other videos in this series when we pick up. Suffice to say, just to summarize, suffice to say is that when you have issued financial guarantee contract, the core requirement is that at initial measurement, it should be at fair value. But then what happens subsequently? You have recorded at fair value in my example as 600. What happens subsequently? Let us see on the right hand side. Now subsequently, let's say this journal entry, when you see this, okay? Now the fee which has been charged by the guarantor, that fee is required to be amortized by the guarantor in the P&L as the revenue, okay, over the life of the guarantee. So for example, if that 600 rupees of the guarantee fee is in respect of, let us say, a guarantee which spans over 3 years, then on an SLM basis, 200 rupees per year over the 3-year period is going to be recorded by the guarantor in its P&L account as the guarantee fee income by applying the revenue recognition standard Ind AS 115 or IFRS 15 from an IFRS world. And as I mentioned, mostly this is something which will be recognized on a straight line basis by the guarantor. Again, of course, the pattern of recognition may change, but assume for the time being it is on a straight line basis. So what will happen? The journal entry which was recorded here, cash of 600 and the liability of 600 was recorded. Now, at the end of year number 1, out of this 600, 200 will get recognized as the income. And therefore, you will reduce your liability for financial guarantee to the extent of 200 for which you are recognizing revenue. So, at the first end of the year, the journal entry which will be recorded by the guarantor would be debit financial liability, the liability for financial guarantee. This amount get reduced by 200 rupees so that the carrying amount of this liability in the books of the guarantor gets reduced from 600 to 400. And therefore, to the extent of 200 rupees, there is an income which gets recorded in the profit and loss account of the guarantor. So this is the one leg of the entry related to the financial guarantee contracts on the subsequent measurement. Now, the fact of the matter is the guarantor is still exposed to the risk that if the borrower, in my example, if ABSPL makes a default, then Mr. A will still come back to the guarantor and ask for the compensation. And therefore, guarantor also need to measure or remeasure what it is its liability at each reporting period. And the standard tells you that in the balance sheet, apart from the fact that in P&L, the guarantor will record 200 rupees by way of amortization or unwinding of this particular amount, they will also need to remeasure what should be the carrying amount of this financial guarantee liability on the books. And for that, this is given in the standard that this carrying amount will be higher of these two numbers. What is the higher of these two numbers? Higher of these two numbers means what is at the, so let's continue the example. You started the, so okay, let me do it this way. You started the financial guarantee at this point in time. At the end of year number 1, You recognize 100 rupees worth of your, 200 in my example, 200 rupee worth of the income here you have recognized. Now, you have to reassess that at the end of year number 1, what is my possible liability? That liability will be given by what is the likely loss allowance at each reporting period to which the entity or the guarantor is exposed to. This is determined by applying Ind AS 109 impairment requirement, which is 12-month ECL or lifetime ECL as the case may be. Now, so whatever that amount is, and if you look at what is the carrying amount in this example, which is continuing in the books of the guarantor, you initially recognize 600 rupees minus you already recognized 200 rupees at the end of year number 1. So therefore, you are left with 400 rupees of the balance in your liability, which you initially recognized. 600 initially recognized minus 200, which you taken to P&L by debiting this liability. So 400 as compared to what is the exposure which you have at the end of year number 1. Higher of these two amounts you need to record. Therefore, if the carrying amount of 400 happens to be lower, let us say this loss allowance expected is 450 at the end of year number 1. Therefore, apart from recording this revenue, they will also need to record what is called the impairment loss, because to the extent of 50, your liability carrying amount is lower than what it should be. And therefore, you need to record one more entry to the extent of debiting P&L by 50 rupees by creating by way of impairment and increase your liability by 50 rupees. What will happen because of the second entry? So the net effect of these two entries will be that you started with 600 rupees of your liability. You reduce it 200 by way of taking to revenue, and then you added 50 rupees more to the liability because of the impairment, expected impairment loss. Therefore, your liability at the end of year number 1 will be 600 minus 200 plus 50, which is equal to 450. And this 450 is nothing but what you are expected to have your exposure at the end of year number 1. I'll explain this with the help of one case study as well. Let us see how it all works out. As I said, true up or true down is required to go to P&L. 50 in my example. That loss allowance of 450 vis-a-vis the carrying amount of 400, which is 600 minus 200. The difference of these two, the true up, is required to the extent of 50, and that goes to the debit of P&L by way of impairment loss. This is what we will explain the accounting in the next 2-3 slides by way of a case study. So let us see the case study. In this case, similar to what I just mentioned, we have a scenario that on 1st of January 2022, Mr. A, this guy, Mr. A, has issues a financial guarantee contract to ABSPL. So A is the guarantor. It has issued a guarantee to ABSPL. So he is the guarantor. The facts have changed in this particular case study. And what is the guarantee for? The guarantee is to ABSPL, who is holding a pool of trade receivable. This pool of trade receivable is being held by, this pool is held by this ABSPL. So the guarantee, as per the guarantee terms, what it says, the contract says, you are issuing the guarantee in January 2022. Now next 3 years, let's say by end of December 2024 or January 2025, let us say for the next 3 years, after 3 years, the contract says after 3 years, whatever loss gets sustained by ABSPL on account of this pool of trade receivables, that is being guaranteed by Mr. A. So therefore, if you look at the second point, it says what? As per the contract, as on 31st of January 2025, which is 3 years roughly from the date of the issue of the guarantee, Mr. A, the guarantor, will reimburse ABSPL for all the defaults which ABSPL sustains during 22 to 24 from this specified pool of trade debtors. And it is also given to you in this, in this case study that Mr. A expects that the total default will be rupees 40 per annum, aggregating to 120 over the 3 year of the guarantee period. Now assume that this estimate, this was something which was the expectation. For the time being, assume that this expectation turned out to be correct. So assume that defaults are incurred as per the expectation. And Mr. A determines that therefore it will recognize the consideration that this guarantee which has been taken was for a consideration of 300 for a 3-year period. So the Mr. A has determined in this case that this 300 rupees they will account for on a straight line basis, as I indicated in the previous slides as well. And also, this is very important, Mr. A expects that the loss allowance of 120 will be applicable at each reporting date. You remember we said we need to compare the possible loss allowance versus the carrying amount. Now this loss allowance is expected to be 120 at each reporting period. So how, with this fact pattern, accounting will be done by the issuer? Let us see the solution in the next couple of slides. So as we have seen, at initial recognition, which is on 1st January 2022, you have to record it, the entry at fair value. Fair value, because it's a third party transaction, we will presume that the 300 rupees of the premium charged is the fair value, and therefore the journal entry which will be recorded by this issuer of the financial guarantee is cash of to the extent of 300 received, and they will set up a corresponding liability sitting in the balance sheet in respect of the possible future obligation. Now, subsequently, at each reporting period, you entered into this at the beginning of year. If calendar year is the financial year for that particular entity, a year in December 22, 1 year later, 2 year later, 3 year later, what will happen? Now, as I said, in this case study, it is presumed that this need to be recognized as income on a straight line basis. So therefore, the entry would be, you will credit P&L to the extent of fee income of 100, 100, 100 in each of the year. And to the extent of this, you will reduce your liability. So you will debit the liability, which is sitting here at 300 rupees, and at 100, 100, 100, technically at the end of the year, by recording this end of the 3 year, the liability comes to 0, and the 300 rupees of cash which you collected gets recognized as the income. So this is the entry which you will keep recording every year. Thereby, this 300 rupees gets recognized in income on a SLM basis, 100 each. Now, if you record the entry this way, just for reference purposes, what would be your closing carrying amount of the liability? Because you started with 300 of the liability, you recorded 100 and debited this liability by 100. So you will be left with 200 at the end of first year, 100 at the end of second year, and it will become 0 at the end of third year. But then we saw subsequent measurement of the financial guarantee related liability is higher of the two amounts. This amount, which is being carried in the balance sheet, and the expected loss allowance. So let us see how that works out in this case. We have seen what need to be carried. The amount which you need to carry in the books is higher of these two amounts. And the problem says, in the case study, it is given that at each reporting period, the entity is expecting that the expected loss allowance at each reporting period will be 120. But what is your balance? After you have recorded this entry, your balance is 200, 100, and 0. So if you compare these two numbers, this and this, higher of these two numbers for each year should be your carrying amount. And that's exactly what is being mentioned here. This is your should be carrying amount. Higher of these two numbers. This should be your carrying amount at the end of each year. Now compare this, for example, year number 1. So in year number 1, you have a carrying amount of 200 and you are expected to have carrying amount of 200, you are expected to have carrying amount of 200. That means there is no additional impairment here in year number 1, and therefore no impairment will be recorded in year number 1. But what about year number 2? If you see here in year number 2, your balance is only 100. Why? 300 minus 100 minus 100, which you recognize in 2 years. So your balance is 100 only, but you expect to have 120 because of your obligation here. And therefore, there is a shortfall of 20 rupees. That 20 rupees shortfall will be recorded as an additional impairment loss. And that's exactly what you see at the bottom. You have to record additional entry for impairment loss. Why would you record that impairment loss entry? Because of comparing these two numbers. And therefore, in the first year, there is no impairment loss. In the second year, you have 20 rupees impairment loss. As I just explained, you are required to carry 120, but you have only 100 rupees. And therefore, the shortfall of 20 gets recorded. Same way, in year number 3, the shortfall of 100 will get recorded. And the same, these numbers, if you look at, this will get reflected in the extracts of P&L and balance sheet. So how the balance sheet will look like? Just we saw in the previous slide as well. Higher of these two numbers, okay, should be your carrying amount in the balance sheet. So for year number 1, higher of these two numbers is 200, 120 and 120 is what we have seen. That's how your balance sheet extracts will look like. And when it comes to P&L overall P&L will have if you look at the extracts, it will be like this. In the first year, you recorded an income of 100, no impairment. So therefore, net, your income in the year number 1 is 100. In year number 2, you will record the income of 100, first entry, but then you will record impairment loss of 20, and therefore your net income in the P&L would be 80 in respect of this particular financial guarantee contract which you have issued. And in third year, you will recognize 100 rupees of initial income, but then you will also have to record 100 rupees of impairment on account of this analysis, and therefore net P&L would be 0. So in effect, if you look at what is the net effect of this, 180 rupees is your net P&L, right? And here the balance sheet, every year you are comparing these two numbers and carry your liability as it should be. So that's what I wanted to cover in this particular video, and I will have this discussion going on because this is a much more, a topic which we need to go in much deeper, much more deeper into this particular topic. We will continue our discussion on this. I've also given my social media contacts here. Feel free to connect with me, and if you think these videos are something which is very useful to you, then consider subscribing the channel. That way you will not miss out any of the videos which I am recording and loading on the channel. Thank you very much for your time, and we will see you soon in the next video. Thank you. Bye.